Listen, if you've been watching gold absolutely demolish every price record this year and wondering whether you've missed the boat or if you should be loading up even more before 2026, this video is going to give you some serious clarity. Because right now, as I'm recording this on Christmas Day 2025, gold is trading at over $4,400 per ounce, and silver just smashed through $70. These aren't just numbers on a screen anymore. These are wake-up calls that the financial landscape is fundamentally shifting beneath our feet. And here's what nobody's telling you about the whole "how much precious metals should you own" question. Every single financial guru out there is throwing around percentages like 5%, 10%, 20%, but they're not explaining what those numbers actually mean for your specific situation. They're not talking about whether you're trying to preserve wealth, grow wealth, or protect against a complete system breakdown. And that distinction, that's everything. So we're going to break down exactly how much gold and silver you actually need heading into 2026, based on real data, expert forecasts, and most importantly, based on what you're actually trying to accomplish. I'm going to walk you through the traditional recommendations, then show you why those might be completely wrong for 2026, and finally give you a framework you can actually use to make this decision for yourself. Because, spoiler alert, the answer isn't the same for everyone, and anyone telling you otherwise is selling you something. Before we talk about 2026, we need to understand what just happened in 2025, because it's genuinely unprecedented. Gold started the year around $2,600 per ounce. Right now, it's trading above $4,400. That's a 70% increase in a single year. Let me say that again, 70%. For context, that's one of the strongest single-year performances for gold in modern history. But here's where it gets really interesting. Silver has absolutely crushed it. Silver entered 2025 at roughly $30 per ounce and just broke through $70. That's more than a 130% gain. Some analysts are now calling this the silver squeeze they've been predicting for years. The metal that everyone called the poor man's gold just outperformed almost every major asset class on the planet. So what drove these insane moves? Three massive forces converged at once. First, central banks went on an absolute buying spree. According to JP Morgan's research, central banks have been accumulating gold at the fastest pace we've seen in decades. Countries like China, Russia, and India have been diversifying away from the dollar. And they're not being subtle about it. When central banks buy this aggressively, it sends a signal that something fundamental is changing in the global monetary system. Second, we saw the return of significant ETF inflows. For years, institutional investors were rotating out of precious metals into tech stocks and crypto. That trend reversed hard in 2025. The uncertainty around tariffs, geopolitical tensions, and questions about long-term inflation brought big money back into gold and silver ETFs. When you see billions flowing into these vehicles, it creates sustained upward pressure on prices. Third, and this is crucial for silver specifically, we're dealing with genuine supply constraints. Silver isn't just a monetary metal anymore. It's become absolutely essential for solar panels, electric vehicles, and advanced electronics. The green energy transition isn't some distant future scenario. It's happening right now, and it's devouring silver supply. Bank of America's research indicates that industrial demand for silver has created a structural deficit that mining production simply cannot fill. This isn't a temporary squeeze. This is a fundamental supply-demand imbalance. Now, let's talk about what the people who get paid millions of dollars to be right about this stuff are saying about 2026. And I want to warn you, some of these targets are going to sound absolutely crazy until you understand the reasoning behind them. Ed Yardeni, a veteran market strategist who correctly predicted gold would top $4,000 by the end of 2025, just raised his year-end 2026 target to $6,000 per ounce. Read that again? $6,000. His longer-term projection suggests we could see $10,000 gold by the end of this decade. Now, before you dismiss this as sensationalism, understand that Yardeni's track record on this specific call has been nearly perfect. When he said 4,000 by year-end, people laughed. He was right. JP Morgan Global Research is projecting that gold will push toward $5,000 per ounce by the fourth quarter of 2026, with $6,000 being a legitimate possibility longer term. Their analysis specifically cites continued central bank purchases, sustained ETF demand, and ongoing tariff uncertainty as the primary drivers. Goldman Sachs, which has historically been more conservative on precious metals, is maintaining its bullish gold forecast with substantial upside targets for 2026. For silver, the forecasts are equally eye-opening. Bank of America sees silver climbing to approximately $65 per ounce by 2026, with averages around $56. But here's the kicker. Some technical analysts are suggesting that if the gold to silver ratio compresses the way it has historically during precious metal bull runs, we could see silver testing triple digits. $100 silver sounds insane until you remember it was trading at $30 just 12 months ago, and nobody predicted a $70 move either. What's fascinating about these forecasts is that they're not based on some apocalyptic scenario or dollar collapse theory. The bull case for precious metals in 2026 is actually quite straightforward. We're living in an era of persistent uncertainty. Geopolitical tensions aren't decreasing, they're intensifying. Fiscal deficits in major economies aren't shrinking, they're expanding. And perhaps, most importantly, trust in traditional fiat currencies and institutions is eroding in ways we haven't seen since the 1970s. Wealth managers surveyed by Investment News indicate that more financial advisors are recommending increased precious metals allocations heading into 2026 than at any point in recent memory. This isn't fringe anymore. This is becoming mainstream portfolio construction. All right, let's get into the meat of the question. How much gold and silver should you actually own? The traditional wisdom from financial advisors has generally suggested allocating between 5 and 10% of your total investment portfolio to precious metals. Some conservative estimates start at just 2 to 5%, while more aggressive recommendations push toward 15 or even 20%. The reasoning behind these ranges is pretty straightforward. Precious metals are meant to serve as portfolio insurance, not your primary wealth-building engine. They're the assets that tend to hold value or even increase when other parts of your portfolio are getting crushed. During stock market crashes, currency crises, or periods of high inflation, gold and silver typically perform their role as wealth preservers. The legendary investor Ray Dalio, founder of Bridgewater Associates, has publicly stated that investors should allocate about 15% of their portfolios to gold. His all-weather portfolio strategy specifically includes meaningful precious metals exposure because he views them as essential for true diversification. When someone with Dalio's track record makes a specific allocation recommendation, people listen. For conservative investors focused primarily on capital preservation, the typical recommendation falls in the 5 to 10% range. These are people who are either near retirement or who have already accumulated significant wealth and are primarily concerned with not losing it. For them, precious metals serve as a defensive position, a hedge against catastrophic scenarios without taking up too much portfolio space. Moderate risk investors, who are balancing growth with safety, typically see recommendations in the 10 to 15% range. This allocation provides meaningful exposure to precious metals' upside potential while still maintaining the majority of the portfolio in growth-oriented assets like stocks and real estate. Aggressive investors who are specifically concerned about systemic risks, major inflation, or currency devaluation might push their allocations to 15 to 20% or even higher. These are individuals who view precious metals not just as portfolio insurance, but as a genuine wealth-building opportunity during the specific macro environment we're living in. Here's where we need to have an honest conversation. The traditional 5 to 10% allocation guideline was developed during a very different era. It was created in a world where the dollar was unquestionably the global reserve currency, where central banks weren't buying thousands of tons of gold annually, where geopolitical stability was relatively assured, and where we weren't facing the structural supply deficits in silver that we're seeing today. That world doesn't exist anymore. The macro environment heading into 2026 is fundamentally different from what it was even 5 years ago, let alone 20 or 30 years ago, when these allocation guidelines were popularized. This doesn't automatically mean you should massively increase your precious metals allocation, but it does mean you need to question whether the old rules still apply. The data we're seeing from institutional surveys is telling. According to research from multiple sources, including goldsilver.com's industry analysis, more investors are planning to significantly increase their precious metals allocations in 2026. This isn't retail panic buying. This is sophisticated family offices, wealth managers, and institutional investors systematically shifting capital into gold and silver. For silver specifically, we're dealing with something that's never happened before at this scale. Silver is simultaneously a monetary metal, an industrial metal crucial for green technology, and an investment vehicle experiencing unprecedented retail and institutional demand. The mining industry is producing about 800 million ounces of silver annually, and current consumption is exceeding that by significant margins. Every major forecasting organization, from the Silver Institute to independent analysts, acknowledges we're in a structural deficit. When you're dealing with a structural deficit in a commodity that cannot be easily or quickly increased in production, and that deficit is driven by irreversible trends like electrification and solar adoption, the price dynamic fundamentally changes. This isn't speculation about future demand. This is actual physical demand happening right now that cannot be met by current production. Then there's the elephant in the room that nobody in mainstream finance wants to talk about openly. The dollar's role as the unquestioned global reserve currency is being challenged in real time. The BRICS nations aren't just talking about alternatives anymore. They're building infrastructure for dollar-independent trade. Central banks in major economies are systematically reducing their dollar reserves and increasing gold holdings. This is a multi-decade trend that has accelerated dramatically in the past 2 years. If you believe, even partially, that the dollar will face challenges to its dominance over the next decade, then the traditional allocation guidelines for precious metals are potentially grossly inadequate. This is why you're seeing serious strategists like Ed Yardeni projecting $10,000 gold. That's not a forecast about gold going up. It's a forecast about what happens to gold priced in dollars if the dollar's purchasing power continues to erode. Here's the truth that nobody wants to hear. There's no perfect percentage that works for everyone. Anyone who tells you definitively that you should have exactly 10% in precious metals without knowing anything about your financial situation, your goals, your risk tolerance, your time horizon, or your beliefs about the macro environment is giving you garbage advice. What you need instead is a framework for making this decision yourself. So here's how to actually think about this. First, get crystal clear on what you're trying to accomplish with your precious metals allocation. Are you primarily concerned with portfolio volatility and want some non-correlated assets? Are you worried about sustained inflation eating away at your purchasing power? Are you concerned about potential currency crises or systemic financial instability? Your allocation should reflect your primary concern. If you're just looking for basic portfolio diversification and some inflation hedge, the traditional 5 to 10% allocation probably makes sense. This gives you exposure to precious metals benefits without dramatically altering your portfolio's growth potential. If you're genuinely concerned about major inflation or currency devaluation over the next several years, you probably want to be in the 10 to 20% range. This gives you meaningful protection if those scenarios play out while still maintaining majority exposure to growth assets. If you believe we're heading toward a serious monetary crisis or major systemic disruption, some investors go even higher, 25% or more. This is a very specific position that requires you to be comfortable with your portfolio looking dramatically different from conventional allocation models. Your time horizon matters enormously. If you're planning to hold these assets for 10, 20, or 30 years, you can weather significant volatility and potential consolidation periods. Long-term holders can take advantage of the secular megatrends around de-dollarization, monetary instability, and silver's industrial demand without worrying about year-to-year price swings. If your time horizon is shorter, you need to be more tactical. Buying precious metals at all-time highs with a short time horizon is inherently riskier. You're betting that the momentum continues rather than betting on the long-term fundamental case. This is crucial and often overlooked. Are we talking about physical gold and silver that you hold directly, or are we talking about ETFs, mining stocks, and other paper proxies? The allocation discussion changes significantly based on this distinction. Physical metal that you hold directly serves a very different purpose than shares in an ETF. Physical metal is your ultimate insurance policy, your wealth that exists outside the banking system and financial markets entirely. Many serious precious metals investors operate on a two-tier system. A core allocation of physical metal for true insurance purposes, separate from their paper market exposure through ETFs or mining stocks. A reasonable approach might be 5 to 10% of your portfolio in physical metals that you view as essentially untouchable insurance, plus additional exposure through ETFs or miners if you want more tactical exposure to precious metals, price movements, without the logistics of storing significant physical quantities. Let's get practical. If you're convinced that you need to establish or increase your precious metals allocation heading into 2026, how do you actually do it without making catastrophic timing mistakes? First, recognize that we're at or near all-time highs in both gold and silver. This doesn't mean prices can't go higher. The forecasts we discussed suggest they likely will, but it does mean you need to be smart about implementation. Dollar cost averaging into your target allocation over several months or quarters can help reduce the risk of buying everything at a potential local top. If your target allocation is, say, 15% of your portfolio, and you currently have zero precious metals exposure, consider building that position over 6 to 12 months. This gives you the opportunity to buy on any pullbacks, while also ensuring you get exposure if prices continue rallying without waiting for a correction that might never come. For those who want to be more strategic, pay attention to the gold to silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has cycled between extremes. The 80-50 rule suggests buying silver when the ratio goes above 80, indicating silver is cheap relative to gold, and buying gold when it drops below 50, indicating silver is expensive relative to gold. As of late December 2025, the gold to silver ratio has been compressing, meaning silver has been outperforming gold. If you believe this trend continues, you might weight your allocation more heavily toward silver. If you think the ratio will stabilize or expand again, gold becomes relatively more attractive. If you're buying physical metal, you need a plan for storage and security. For smaller allocations, a high-quality home safe can work. For larger positions, you might want to consider professional vault storage, either through your dealer or specialized facilities. Many investors split their holdings, keeping some at home for immediate access and storing larger quantities professionally. Remember that physical precious metals are illiquid compared to stocks or ETFs. You can't sell half an ounce of a gold coin instantly at market price the way you can sell shares of an ETF. This illiquidity is actually a feature for long-term holders. It forces you to hold through volatility, but you need to structure your overall portfolio so you're never forced to sell physical metal at an inopportune time to meet cash needs. In the United States, physical precious metals are treated as collectibles for tax purposes, meaning long-term capital gains are taxed at a maximum rate of 28%, rather than the standard 15 or 20% for stocks. This doesn't necessarily change whether you should own them, but it should influence how you hold them. Precious metals IRAs allow you to hold physical metal in a retirement account where gains are tax-deferred or tax-free, depending on whether it's a traditional or Roth IRA. Now, let's play devil's advocate for a moment, because intellectual honesty requires considering the other side. What if all these bullish forecasts are wrong? What if we're actually at the peak of a speculative bubble in precious metals, driven by the same kind of momentum and FOMO that drives every other asset bubble? The bears on precious metals make some legitimate points. Gold and silver don't produce income. They don't grow earnings. They don't innovate or create value. They just sit there. In a long-term portfolio, opportunity cost matters. Every dollar in gold is a dollar that's not compounding in productive assets. If we enter a period of genuine deflation, or if confidence in the financial system somehow strengthens dramatically, precious metals could underperform significantly. There have been multi-decade periods in history where gold and silver went essentially nowhere in real terms, while stocks and real estate multiplied wealth many times over. Additionally, if you're overexposed to precious metals and we see a major consolidation or correction in 2026, you might find yourself emotionally unable to hold through the drawdown. This is why allocation sizing matters. You need to hold a position size that allows you to be rational when prices move against you, not one that causes panic. So here's my synthesis. After looking at all this data, all these forecasts, and thinking through the framework, if you currently have zero precious metals exposure, you should seriously consider establishing at least a basic allocation of 5 to 10% heading into 2026. The macro environment, the supply-demand dynamics, and the institutional positioning all suggest that precious metals are likely to play an increasingly important role in portfolio construction going forward. If you already have a traditional allocation in the 5 to 10% range, and you're genuinely concerned about the specific risks we've discussed, monetary instability, persistent inflation, geopolitical tensions, you might consider increasing that allocation toward 15 or even 20%, but do it thoughtfully, with a plan, and in a way that doesn't compromise your ability to hold through volatility. For silver specifically, the supply-demand case is extraordinarily compelling. If you believe in the green energy transition and the electrification megatrend, silver deserves serious consideration as a meaningful part of your precious metals allocation. The potential for silver to significantly outperform gold over the next several years is real, though it comes with higher volatility. Whatever you decide, make it a conscious decision based on your specific situation, not a reaction to fear or greed. Write down your allocation target, write down your reasoning, and revisit it periodically as conditions change. The goal isn't to have the perfect allocation. The goal is to have an allocation that makes sense for your circumstances and that you can actually stick with. If this video helped clarify your thinking on precious metals allocation for 2026, hit that like button and subscribe for more content on navigating these complex financial markets. Drop a comment below telling me what percentage you're targeting and why. I read every single comment, and I'm genuinely curious about how different people are thinking about this. And if you want to go deeper on precious metal strategy, check out my video on the gold to silver ratio and how to use it for tactical positioning. I'll link that in the description. Remember, we're all trying to figure this out together. Nobody has perfect information, nobody knows the future, but we can make informed decisions based on the best data and analysis available. Thanks for watching, and I'll see you in the next one.